A lot has changed when it comes to credit in the last 40 years. Things have become more automatic. Okay, back in the days, it was more manual. You got to really call the credit bureaus and all that kind of stuff. Nowadays, you have to really, you can do things online. You can do things automatically by through third-party services. So, into this conversation, I want to explain to you what I've learned in the last 40 years when it comes to a credit. Okay, the thing is that the way credit works hasn't changed at all. I mean, back then it was a pretty it was pretty primitive, if you will, but the numerical aspect of it, it has been the same. In other words, for credit scores, you always have for FICO scores specifically, you have 300 all the way to 850, and that hasn't changed at all. Okay, in the last 40 years, it has always been like that. So if you have no credit when you started, like back then, if you are like, let's say, an 18-year-old and you had no credit, you had no credit experience, you would be started at 300. It's the same thing today. If you are a young adult with no credit experience, your credit score is 300. Same thing if you, let's say, you file for bankruptcy or you had some kind of derogatory item on your credit file. Okay, 300. And the thing is that basically back then you had revolving credit, you had installment credit, but you didn't have what we have now, which is service credit. And that's a new improvement that has happened a new improvement that has happened in the last 10 to 15 years. So revolving credit, everybody know revolving credit. I'm speaking about credit cards. I'm speaking about personal lines of credit, right? In terms of installment credit, you are looking at your personal loan, but the new the new credit category that has been actually more prominent in the last 10 to 15 years is service credit. So service credit is the type of account that you have with anyone who provides you with a service and bills you monthly. So your utility and cell phone bills are examples of service credit accounts. Okay, that's really an important element to think about because basically, first of all, 20 years ago we didn't have. I mean, 20 years ago or 40 years ago we didn't have the cell phone thing. So there was no this sort of service credit thing. So nowadays you also have service credit. So people always think about revolving credit and installment credit. But please don't forget your rent. Don't forget your utility bill. Don't forget your phone bill, for instance. In the last 40 years, when it comes to credit knowledge, one thing that hasn't changed is actually the fact that you can really build credit with a credit card. You can start building credit with a credit card. The thing is that maybe getting your first credit card might be hard. Your first unsecured credit card might be hard, but whether you have it unsecured or secured, you are still building credit. Why? Because the credit card issuer will report your data to the credit bureaus. But what has changed really is the automation here. Back in the days, credit card issuers were reporting data to the credit bureaus every 3 months or every 2 months. Nowadays, it's happening monthly. It's happening every month. So that's kind of cool. And the cool thing is that you have all kinds of different cards. You have secured credit cards. You have student credit cards, and you have hybrid credit cards. You have debit, credit, hybrid cards. Okay, those are relatively new. They actually arose during COVID, like 5 years ago. And the cool thing about those hybrid debit and credit cards is that they give you a good opportunity to build credit. They typically don't require, let's say, a credit check to get approved. And while some require, let's say, a security deposit, you will typically get more flexibility compared to a traditional secured card. The cool thing about credit in the last 40 years is the fact that you have student credit cards. I mean, back in the days, like 40 years ago, you didn't have student credit cards. Why? Because the industry was new, the industry was nascent, and credit card providers were kind of scared about, let's say, extending credit to kids, quote unquote. I mean, kids, literally, 18 years old or 19 years old or 20 years old. But today you have a lot of options, and a lot of big banks, including Discover and Chase, are actually having student credit cards. So if you are a student, you can still qualify for a credit card. Also, you can become an authorized user nowadays. 40 years ago, 30 years ago, it wasn't possible. It was much harder to actually build credit by becoming an authorized user. Today, it's become a lot easier. So if you have no credit, you have the possibility to actually become an authorized user and actually, be added to an existing account and be given your own card to use. This is a very, very smart and potentially powerful development for credit card issuers, but also for consumers. Okay, we didn't have that 20 years ago. We didn't have that 25 years ago. It started. It started for real about 18 to 15 years ago. So that's very powerful. In the last 40 years, when it comes to credit, one thing that hasn't changed is your ability to build credit by paying your bills on time. 40 years ago, the concept was similar to the concept that you have today. Same concept. When you actually have a balance on your credit card, you want to pay that balance, or at least pay the minimum requirement every single month. Okay. If you already have a credit card, there are ways to make sure you are getting the most benefit out of it. Start with making on-time payments. It hasn't changed for the last 4 decades. That's really important. Now, what has changed here is the percentage of, let's say the percentage of a good payment history in your FICO score. When the FICO score was like a couple of years ago, the percentage of bill payments was 28 to 31%, and they increased it gradually to 35%. So today, you basically have the bill payment history accounts for 35% of your FICO score. So if you want to increase your FICO score, you definitely want to pay your bills on time. Okay. And also, the ability to request a credit limit increase has changed big time. It has changed in the way consumers are able to request an increase, but also the magnitude of the increase. Back in the days, back 40 years ago, 40 years ago or 30 years ago, it was completely impossible for consumers to actually request a credit limit increase. The limit increase came from the credit card issuers. In other words, only the issuers will say, "Listen, we think your account is positive, so we are going to increase your limit." Nowadays, consumers have gotten more power, so they can actually call their credit card issuer and say, "Listen, I want to really have an increase because blah 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 blah." Okay, so that's the first development, and that has changed a lot in the last 20 years. Another thing that has changed is the way to ask for the credit limit increase. Nowadays, you can ask for a credit limit increase actually on the phone. You can ask at a branch if the credit card issuer is a credit union or a bank. But also, you can actually request a credit limit increase by logging to in the credit card issuer's app. Nowadays, it's really possible to ask for a request increase. I mean, an increase request through the mobile version of your credit card issuer's platform. So that's really fantastic. 20 years ago, 40 years ago, we didn't have that. One thing that has changed in the last 20 to 30 years is that basically you are able to build credit nowadays without a credit card. I mean, 20 years ago, 30 years ago, a credit card was, let's say, the easiest way to start building credit, right? You just get your first credit card, and then you start using your credit card, and then that's how you build credit. Nowadays, you have a lot more possibilities. I've said this before, but I want to insist on that, and that has changed a lot for consumers in the last 40 years. I mean, to their benefit, to consumers' advantage. Okay, why? Because if you don't like credit cards, if you don't like using credit cards, you can still build credit. You can try to get a loan, for instance, an installment loan. You can try to get a line of credit. A line of credit is kind of similar to a credit card in the sense that it is a revolving line of credit. But the only thing is you don't carry a plastic in your wallet. Okay, you just need to use the cash differently. But you can also add monthly bills to your credit report. So the monthly bills are basically what I was asking you before. I mean, asking you when I was telling you before, and what I was calling service credits. Okay, and you can do that as well. And by the way, there is actually something didn't exist 20 years ago or even 10 years ago. It's the fact that you have service credits that is not just from a utility company. You can have a service credit from a credit reporting agency. For instance, you have Experian offering that kind of possibility so that you can really just build credit. Okay. You can also try to get a cosigner. So this is something that was prominent like 20 years ago, 40 years ago, when a lot of kids were trying to build credit. So getting a cosigner is actually a good way to start building credit real fast. Another possibility, if you are trying to really build credit this year, which we didn't have 40 years ago, we didn't have 30 years ago, or even 20 years ago, was something called credit builder loan. Nowadays, you have something called credit builder loans that didn't exist back then. So if you are new to credit, or you just, let's say you just filed for bankruptcy, you have a big derogatory item on your credit, you have the possibility to have a credit builder loan. Okay. So a credit builder loan can be a great starting point for you if you have limited or no credit history. So that's kind of cool. So terms can vary by lender, but those loans typically range from $300 to $1,000, and they have a repayment term of 6 to 24 months. The bottom line is that you are able to accumulate some kind of savings amount, while also building credit. So that's a very, very good development for you. So in the last 40 years of credit, one thing that hasn't changed is actually, one thing that has changed is the composition of the FICO score. 30 years ago, the FICO score was not as prominent as it is today. Today, everybody who is serious about building personal credit has to care about FICO big time. Okay, now the composition has changed. Nowadays, you have a payment history accounting for 35%, amounts owed accounting for 30%. Amounts owed is the same thing as the CUR, the credit utilization ratio. You have the length of credit history, 15%. You have the credit mix, so 10%, and you have new credit, 10%. Back then, payment history, I think I've said this before, payment history was around 30%. Amounts owed was around 25%. Length of credit history was around 20%. Credit mix was around 12 to 14 to 15%, and new credit was still around 10 to 11%. So you can see that the composition, the numerical amounts, the numerical prominence of those different payment histories, let's say those credit terms, credit categories has changed a lot. So that's really good. That's really good in terms of flexibility, and it's bringing an extra layer of credibility to the market, an extra layer of flexibility. One thing I've seen in the last 40 years when it comes to credit is the fact that things that affect your credit score now are even more diverse. Back then, if you had, let's say, if you had if you missed a payment 1 month or 2 months, the impact was not actually immediate on your credit. It will take a big thing like bankruptcy, or let's say repossession of your car, whatever, for you to really see the impact on your credit score. Nowadays, every little thing, even little things can be reflected to your credit score big time, and the reflection is actually almost immediate. Because of technology, you are able to really see the impact right away. So that's something to really think about. So in the last 40 years, when it comes to credit, basically the definition of a good credit score has changed big time. Okay, back then, basically, if you had a 600, 650 as a credit score, you were good already. You were good to go. Nowadays, things have been they have been multiple layers. So you have the poor credit category that goes from 300 to 579. You have the fair credit category that goes from 580 to 669. The good credit category from 670 to 739. Very good 740 to 799. And exceptional to 800 to 850. The thing here is that what has really changed big time is actually the fact that nowadays, if you have 600 or 650, that's still not considered good, really. Because if you have 600 to 650, you are in the fair category, and you don't have a lot of option if you are actually in the fair category, unfortunately. Okay, in terms of credit cards, in terms of loans, in terms of lines of credit, you might actually suffer a little bit, or actually have to cope with higher APR or more stringent terms and conditions. But hey, listen, it is what it is. And also, the time it takes to actually build credit has changed a lot. Back then, it was a lot easier and a lot quicker to build credit because you could just build credit with your credit card, with one credit card. You can build credit with one loan. You can build credit with your student loan. You can build credit with your mortgage. Nowadays, you have more possibilities. You have more options, and that diversity of options is actually lengthening. It's really extending how long it takes for someone to build credit. Okay, is it good? Is it bad? It really depends on how you look at it. But one thing I want to say here is that nowadays, if you have a one credit card only, you're not going to build credit that fast. You need to have a diversity of of credit products. As a matter of fact, you there is a factor in your credit score called credit mix that really wants you to really apply for. I mean, not apply for. Have a credit card. Have also a personal loan. Have, let's say, a line of credit. Have, like, you gotta have a diverse set of credit products for you to really increase your credit score. So it is what it is. In the last 40 years of credit knowledge, one thing I've seen is that there are some credit mistakes that you need to avoid. And back then, the potential for mistakes wasn't really high, but nowadays the potential has been really increased big time because of technology, because of a revolution in the industry. You have a lot more players. Okay, so beyond Experian, Equifax, and TransUnion, you have a lot more players, and but those are third party FICO score tracking sites, okay, such as Credit Karma, for instance. So what you want to do is that if you are serious about the credit this year, you want to monitor your credit. You got to monitor your credit. You got to know what's really happening. You got to know what kind of shenanigans, quote unquote shenanigans, some issuers are playing with your credit score. If there is a problem, if there is a derogatory item, you can catch it real fast, and you can nip things in the bud, right? That's what you want. You want to nip it in the bud. If there's a problem, you want to nip it in the bud. You want to report it to the credit bureaus, or you want to take care of things yourself. So you got to monitor your credit. You also got to have a budget, and this is something that wasn't really important a couple of decades ago, 2 or 3 or 4 decades ago. A budget wasn't as crucial as it is today. Why is it crucial today? It's crucial because we are more, quote unquote, tempted to buy stuff, right? We are bombarded by so many promos, so many ads, whatever. So there is a temptation to spend money. But the other thing that you need to pay attention to is that you have a lot of apps. You have mobile apps to help you with budgeting. So you have no excuse to say, you know what, I'm very bad at budgeting. Also, don't just pay the minimum amount due. Don't do that. This will really derail your credit building itinerary, your credit building journey. Okay, you want to pay more because the bottom line is you want to really increase your CUR. Remember, now increase. You want to decrease your CUR. So CUR stands for credit utilization ratio, and you want to decrease it. The lower it is, the better it is for your credit score. There is an inverse relationship between your credit score and your CUR, but also your DTI. Okay, and don't apply for credit too often. Like I said, there are a lot of temptations out there, and we are all bombarded with ads, with solicitations, but with credit solicitations. But don't really succumb to some of those temptations. So as a takeaway into this conversation, I shared with you what I've learned for the last 40 years when it comes to credit. You know, I gave you how credit worked back then, how credit works today, the types of credit you have, how to build credit with a credit card or a loan or a line of credit, and how to build credit without a credit card. Thank you so much. God bless you. I will see you next time. Until then, remember, stay marvelous.